Welcome to the How to Become Your Own Bank. This is our 90-minute presentation on the infinite banking concept, otherwise known as privatized banking or BYOB, become your own bank. So welcome to everybody that's new. Appreciate you all being here. If you've seen this before, welcome back. Hopefully I'm able to share something here this evening that you otherwise didn't know about it. And that's what financial education is all about, is always learning something new and always continuing to improve with your knowledge. So let me share the screen. All right, you guys can all see that. It looks good. I'll pull up the chat box so we can talk as we go here. So a couple things, just a housekeeping real fast. If you're on Facebook, I'm not monitoring the Facebook comments, so you'll have to, I'll respond to them later on when I get on Facebook. We are on a live Zoom call though right now. So next time, make sure you hop on the Zoom and join us on Zoom so that we can, you can ask questions and chat back and forth and all that good stuff. So if you have any questions as I go here this evening, put those in the Q&A box. And the Q&A box, I will answer either as we're going or I'll answer them at the end, depending on if I'm getting ready to answer it anyways or something like that. And then we'll leave the chat box for like corresponding back and forth and stuff like that. So like I said, we're going to get into how to become your own banker and what that's all about. This is a concept that's been around for a couple hundred years. It's used by some of the most wealthiest families in the country. It's used by the banks in this country, and now it can be used by you because I'm going to teach you this. And once you see it, you'll never forget it. I can promise you that. So we're going to have some fun here. I've been doing it myself now for a few years, and John H, the best way to set up an IUL. That's not what this is. So if you're asking about IULs, you're in the wrong place or you just don't understand. So reach out to me and I can send you more information on that. But that's not what this is, not something that I believe in and not something that I would ever own myself. So I would never sell it. All right, so let's get into this. All right, so what we're going to do this evening is let me ask you guys this question. How many of you would like to be able to pay off your debt while still continuing to build wealth for you and your family? How many of you would like to get every dollar back for every car that you'll ever buy, drive, and own in the future? How many of you would like to be able to make purchases, large purchases, real estate, vehicles, boats, airplanes, and recapture all of that money that you spent for those purchases? How many of you would like to be able to invest like you're doing now? Maybe it's private money lending, maybe it's rental properties or Airbnbs, and simultaneously build a legacy for your family while still doing what you're doing anyways. And that's exactly what I'm going to show you here right now this evening. I'm going to show you how to not work any harder, not work any longer, and not take on any more risk, but build that wealth and create that legacy for you and your family without doing anything extra. And that's what this is all about. So let's dig into it. Again, my name's Stephen Nagy. I work hand in hand with Chris Noggle and Brent Kessler with the Money Multiplier. That is my personal cell phone number at the bottom right there. And my email. So write those down or I'll put them in the chat box at the end. And I will be giving away some free books and bonuses as we go here this afternoon. And you can access those right there at moneyschoolrei.com/Snaggy. And more importantly, you will be able to schedule a call with me. So my call calendar is on that link right there. So you get the books and resources and everything sent to you, and you can schedule a call with me so we can talk about your personal situation. If you like what you're hearing this evening, then I'll be able to get in more little detail with you when we talk one-on-one on the phone. And there's no charge. Just so you guys know, everything that I'm teaching you here tonight, everything that we do with the Money Multiplier, you will never pay me a dime. We do not charge anything for any of these services that we provide to you through the Money Multiplier. So I'll talk a little bit more about why that is and how that works as we get going. But I just want to let you know, I have nothing to sell you here tonight. I'm never going to ask you for a dollar. I will never ask you to buy anything. That's not what this is about. This is about training and educating you how to become your own bank. And then if you go off and take off with it from there, that's on you. But you will never pay us a dime. All right, so we're going to get into a little bit here tonight, money and opportunity, more money. What is money? How does money work? How does money flow? And how can you multiply your money? When it comes to opportunity, that's going to be more kind of on you. So what is the opportunities that you're looking at right now to create wealth for you and your family? What kind of investments? Are you looking at buying crypto right now when it's very, very low? Are you looking at taking advantage of the stock market, the volatility that we're seeing right now? Maybe you're doing options trading. I mean, a stock market investor's dream is when there's a lot of volatility in the markets, because I can make these quick options trades in and out, and I can make a lot of money very quickly within a day, intraday trading. Maybe you're looking at real estate. Maybe you're waiting for real estate to come down right now so you can get in and buy some investments and get some flips done. Or maybe you're just looking at doing some quick flips right now, get it done before the market changes. Or you're buying long-term rentals where who cares if the market drops, because the rent's going to be coming in and you're making your spread anyway. So this is all these different opportunities, investments. If you want to learn more about that stuff, we do teach all that through Money School. Chris and I do through Money School. So we do webinars on that. Join us tomorrow on the YouTube channel. So again, if you go to that YouTube channel at the Chris Noggle, we live stream the webinars we do tomorrow right on there. So we have WTF, what the F happened, market update every Wednesday at 9:30 a.m. Eastern, where we get into detail about what is the Fed doing, what is policy, what kind of policy is happening right now that's driving where the markets are going, or driving inflation, or driving the rates that we're seeing. Interest rates are skyrocketing right now. Inflation is crazy right now. All this stuff is all very important. I just don't have time to talk about it here with you right now. I'm focusing on privatized banking with you here tonight. So join us tomorrow for those webinars. I do Money Club Mondays every Monday. We do business building, precious metals every Thursday. So we do tons of training for you. So join us for those topics. But tonight I'm going to concentrate specifically on money, private money, and privatized banking. But just know there's a lot of opportunities that are coming out there. And by the way, if you guys go on to that /Snaggy and you request the bonuses and resources and schedule a call with me, I'll also email you the schedule for all of those webinars that we do every week. And again, all free of charge. You don't pay a dime for any of those. This is all financial education that we bring to you on a weekly basis. That's very, 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 very important stuff. All right. So why am I here right now? Well, the reason that I'm here right now is because of mentors. Something I learned from a very young age. If you can find somebody else that's doing what you want to do, and you can learn from them, and then you apply what they teach you, you can create a lot of success. I mean, we live in the United States of America at the end of the day, right? There's more success and more opportunity in this country than anywhere else in the world at any other time in history. I don't care. I'll argue that all day long. And these people popping on the screen to me have been very important to me over the last 4 or 5 years of my life. So the first one, Brent Kessler, CEO and founder of the Money Multiplier. Between him and Chris, they've taught me everything that I know about infinite banking, this concept that I'm teaching here tonight. I've also obviously studied and read a lot of books. R. Nelson Nash, we'll talk about him in just a second. But when it comes to one-on-one mentoring and training, Brent Kessler is just an amazing human being. So the moneymultiplier.com. Go there. We put up tons of really good videos on the moneymultiplier.com as well. And you guys will get to know the Money Multiplier and Brent Kessler as we roll with things. And then, of course, this guy right here. So if you're on this webinar tonight, you guys probably came from Chris Noggle, one of his advertisements or marketing videos or ads on Facebook or TikTok or YouTube. And Chris is all over the place. Chris is known as America's #1 money mentor. I met Chris about 4 years ago. We launched a financial education training company doing live events. COVID hit, shut all of the live events down, but we pivoted and we've been doing live Zooms and trainings like this one right here ever since. And we are getting back into live training. So we're putting on a live event in Buffalo, New York at the end of July. If you guys can join us up there for that essentials training, it's unbelievable. We're flying in all kinds of top-notch experts and investors to spend 2 full days with you. Plus, we're going to do a VIP night at a baseball game. We're all going to hang out and network and talk money. So get there. Live events are just an incredible place to not only meet new people and learn new things, but just the energy in the room. And these are lifelong relationships. I mean, Chris, I was introduced to through other business partners, and we ended up meeting at different masterminds and things like that. So it's a wonderful thing. And when I first met Chris, two quotes that I'll share with you that have always stuck with me. First, the one you see on the screen right here. It's never about your actual resources. It's about how resourceful you can be. And I want you guys to really take that quote in, because that quote is everything. The strategies that we teach when it comes to finance and money, they work for everybody. Now, if you have hundreds of thousands or millions of dollars already available to you, whether it's in retirement accounts or savings accounts or business accounts or whatever, just your net worth is up in the millions, great. This will work for you, and it's going to work for you unbelievably powerfully so. It's just a matter of designing it properly and having the right strategy in place for you to take full advantage of it. Or if you're on the other side of the fence, maybe you're just starting out right now, or maybe you've gone through some shit in life and you're just kind of starting over, or maybe you're just getting out of college, or whatever the case might be, right? Or you're just finally taking money and financial education seriously, but you don't have a lot already put away. You've done some stuff already, or maybe you have no savings. Maybe you're $1 million in debt. Maybe you have hundreds of thousands of dollars in debt, third-party debt, whatever the case might be. It doesn't matter. This will work for you. It's just a different strategy that we're going to use. And you'll see that as we go here this evening. And then especially when we start getting into like real estate and investing in private money, we create these win-win situations. Chris and I started a company called Private Money Club. We talked about it several years ago. We started to kind of put it together, launched it last year. It's been an unbelievable success over the last year. So right now we're developing it and putting a ton of money into it and time into it, and really redoing it. We're gonna have the nationwide launch for it in October. But the Private Money Club is this quote right now wrapped up, because right now on this call, I guarantee you, I have a bunch of people that have money and they're looking to put that money to work. And I guarantee you, the other half of you on this call right now, you guys have time, you have energy, and you have that drive, but you don't have the money to get things done that you want to get done. So what we do at the Private Money Club is we pair you together, those that with money and those that need money, and you guys get together, and it creates magic. And that's what this quote is all about right here. So it doesn't matter where you are right now, what side of the fence you're on, you have a money problem. And that's what we do, is we solve that money problem. It's a different money problem, don't get me wrong, but we're going to solve that money problem with everything that we teach. And this is my other favorite quote that Chris introduced me to. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so. Think about that. Write it down, take a picture of it, screenshot it, because that right there is so damn important. And as I go here this evening, you're going to see this come alive. You're going to see exactly what I'm talking about, because we've been programmed our whole life. Go to the bank, put your money in a savings account, put your money in a 401k, do all the stuff that they tell you to do. And then guess what? It doesn't work. But we still do it over and over again. We've been programmed that way. And you're going to see, once you understand privatized banking, the infinite banking concept, and you become your own banker, once you understand how money actually works, you're never going to be able to go back to the other way. It's nothing but BYOB from this point forward. But you got to get that. You got to get your mind to think the right way. And it's not just me saying that this stuff doesn't work, what you've been told your whole lives. It's data, it's statistics. I was a financial advisor and I saw it firsthand. But guess who else tells me? The Social Security Administration. The Social Security Administration tells me, if I take 100 people in this country right now and I look at them at retirement age, only 5% will be successful for retirement, meaning they're going to be able to retire the way, the lifestyle, and the age that they want to retire at. So if we live in the most opportunistic country the world has ever known, it's one of the most opportunistic times in history, then why are 5 out of 100 people able to retire? And the other 95% of Americans are having to push back retirement or change their lifestyle or continue to work longer than they wanted to. Why does that happen? And we're going to talk a little bit about that. But let me ask you guys this right now. How many of you are ready to become the 5%? How many of you are ready to achieve your goals and have the success that you want to in life? Not only in retirement, but right now also. You guys like that? It's the comments? Yes. Why? Yes. All right. I love it. I'm with you right there. So you're my people. You're on here right now, and you're who I'm going to focus on. If we can get the other 95% to come listen to us at some point, great. If not, good luck, man, because we're going to do our thing. So why aren't more people successful. And what I found with my experience of being a financial advisor and being in the coaching and training, financial education and money space for the last 14 years of my life, I found that there's really these 6 reasons are the primary ones. So the top 3 are things that we can actively do right now to eliminate. The other 3, they're up to you. That's mindset stuff right there. So those top 3 are actionable items I can solve for you right now tonight. The other 3 are going to be up to you. And not only does that mean right now tonight, you need to start thinking a little bit differently. Remember what Will Rogers said, not only do you need to think right now tonight, but you need to continue this. Financial education isn't something that you realize and now you're done with it. It's something you're going to learn about day after day, after week, after week, after month, after year for the rest of your life. If my screen wasn't foggy right now and blurred out, if I move around real fast, you can kind of see back there, right? I have more financial education and money books than fit on my bookshelf. They're starting to stack right now. And now I'm starting to stack precious metals, gold and silver, which join us on Thursday. I'll talk more about that. But if I can show you back there, it's all financial education books, everything from Robert Kiyosaki to the books that Chris and Brent wrote to name it. And I probably have it. And if I don't have it, and it's a good book, please tell me about it because I'll add it to my collection. I'll read it. And I like to revisit them now and then too. So highly suggest that. So those bottom 3 are kind of up to you guys, but those top 3 we're going to talk about tonight. So and we'll get into it as we get going here. All right. So there's a book that I want you guys, not a book, a video that I want you guys to check out. Go on YouTube when this is done and type in backwards bicycle. And the backwards bicycle video, it has nothing to do with money, but it has everything to do with money because it's mindset. And it shows us how when our minds are told something our whole lives, or when our minds think one way our whole lives, it's very hard to make a change. And what I'm teaching you tonight is kind of going to go against traditional banking, traditional investing, traditional savings. Once you see it, you'll never unsee it. You'll never go back, but it's going to take a little bit of effort on your part to be able to understand it and see it. So go watch that video, the backwards bicycle, and it's all about mindset, but it's so cool. It's such a cool video. It's like 8 minutes long, but it's 8 minutes well spent. And then if you want to continue and you're just kind of starting out with this stuff, let me give you a couple book recommendations. So first off, anything by Robert Kiyosaki, Rich Dad, Poor Dad. Unbelievable. Those were some of the first books that I read when I first got into real estate and financial education. And to this day, they're unbelievable. I had the opportunity to do some training and do some speaking with Robert Kiyosaki. He's an unbelievable guy in his own right. But what he's done with financial education, he's really brought it. If you guys have kids, go check out the game Cash Flow. And he has one, Cash Flow for Kids now. And it's just a cool little board game you can play with them. But this book right here, Second Chance, that Kiyosaki wrote, that it's all what I'm talking about, the infinite banking concept. This book has it all in it right there. And then Robert Kiyosaki, really just an unbelievable guy. All right. Tony Robbins, Money Master the Game. In that book right there, Tony talks all about the infinite banking concept and what I'm talking about here tonight. R. Nelson Nash, the godfather, the grandfather, the top man of infinite banking. Unfortunately, we lost him a couple of years ago, but an unbelievable guy. And he really is credited with bringing infinite banking and all of this to the limelight. So if you're new to this, that is a must read. That's like our Bible when it comes to banking. So definitely buy that book, Becoming Your Own Banker. And then Chris and Brent wrote an updated version called Mapping Out the Millionaire Mystery. So we'll actually send you a free hard copy of that book if you just pay shipping. But how many of you would like a free digital copy of Mapping Out the Millionaire Mystery that you can read on your computer, your Kindle, or your phone or something like that? Would you guys like that? And if you would, this is one of the books that I'm going to send you free along with the resources. So go to that link right there, put your information in, and I'll send you the digital copy of that book immediately. It'll be automatically sent to you along with the registrations. And then also you could schedule a call with me because after you see this, you're going to want to hop on the phone with me. So go ahead and get the call scheduled now, and then we'll hop on the phone and we'll chat about your personal situation. And then I'll also include one other book for you guys. Chris is the private money guy that starts talking about private money lending, which becomes a very important topic if you want predictable, consistent income for the rest of your life. Private money lending is how we start to accomplish that right there. And this will teach you some of the basics. So I'll send you both of those books, digital copies of those books free, just for being here with me tonight as a bonus. All right. Let's get into this a little bit. So again, I'm Stephen Nagy. I got started out of college as a financial advisor with Ameriprise Financial. Did that for a couple of years, realized it was not for me for a number of reasons. I don't have enough time to get into that right now, but you hear me talk about it on different webinars and podcasts sometimes. But the bottom line is I was introduced to entrepreneurship and real estate investing. I got into that business and I never looked back. Since I've had several different businesses that I've started, I've either sold off or still have now. I've traveled all around the country. So I've trained thousands of students now virtually in all 50 states, but I have traveled to and worked with clients in 47 states, as well as Mexico and Canada. And I do have several businesses now. That is my wife and son of the screen. We live down here in South Florida in the Jupiter area, northern Palm Beach County. So we live in the Jupiter area now. My son is now 6 years old. This picture is a couple of years old. Kids grow like insane. You always hear that kind of thing, like, man, time flies, and capture every minute you can with your kids, because they before you know it, they're adults, and it's always like, oh yeah, whatever, and then it happens to you and you're like, holy shit, it's true. Like, that kid is just unbelievable. But anyways, we have a beautiful life down here in Jupiter, Florida. So just a little bit about me. This is about you guys though, not me. So let's move on. All right, so to understand how this concept works, we just need to understand the basics of money. Okay, so what is money? Like, what is the definition of money? Do you guys know? What is the definition of money? So everybody wants to complicate money, right? You know, when we're growing up, we're always told, oh, don't ask somebody how much they make. Don't ask them about their money. Well, you know, this and that, and no money, you know, we don't talk investing. We don't talk this and that and things like that. It's always like, you know, well, you got to go to a financial advisor to understand money. Like, we don't teach money in school. We don't teach money in high school or really in college. I mean, unless you take specialized like business or finance courses, but this stuff's not taught to us in grade school, high school, things like that. So why is money so secretive? Why is it so like, ooh, quiet, special, things like that? It's not. Money, who said it first? George on here. George said it's a means of exchange. Madeline, a means of exchange. Absolutely, Raul. You guys got it. Spot on. Money is just a means of exchange. It's whether it's a dollar bill, whether it's precious metals, whether it's crypto, whether it's whatever, it doesn't matter. It's just, money is just a means of exchange. I'll trade you this for that, and that's it. That's all money is. Right now, the world currency for money is the dollar bill, the United States dollar bill, but you know, who knows if that'll always be. So that's all money is. It's a means of exchange. And once we start eliminating some of these, oh, money is this, or I have to go to a financial advisor to invest for me, and I can't control my own money, I need somebody else. Nonsense. Who cares more about your money than you do? Nobody. I was a financial advisor. Chris was for 16 years. Nobody cares more about your money than you do. They might be a good salesperson and you might think that they do. They don't. Nobody cares more about your money than you do. Keep that in mind. Compound interest. You're going to hear me talk a lot about compound interest tonight. What company in the United States of America uses compounding interest? And this is kind of a trick question. Nobody does. No companies actually take advantage of compounding interest. Now, banks will take your money and they'll lend it out and they'll compound and grow their money from your money. But when it comes to actual business, no companies actually use compound interest. And it's so powerful. It's so important. Albert Einstein is credited with saying compound interest is the eighth wonder of the world. Those who understand it use it. Those who don't pay it. Remember that. Are your dollars worth more today or in the future? Remember before when I was saying, why aren't more people successful? Well, one of the top 3 reasons is inflation. What is inflation? Inflation is that right there. Your dollars are worth more today than they will be tomorrow, than they will be next month, than they will be next year. Think about it. If a dollar, you know, what does a dollar buy you today? I mean, it takes $6 to buy a gallon of gas. Just a few years ago, it cost $2 to buy a gallon of gas. Now I understand it's going to come down, but that's what inflation is. what you're able to buy today, you're able to buy less of it tomorrow. And so inflation, as currency is inflated, as money is inflated, it really destroys wealth. It creates where it makes it that much harder and harder. So what we need to do is we need to start taking advantage of ways to eliminate inflation from our lives, take advantage of compounding interest, take advantage of laws that are on the books in this country that are going to make you say, inflation, who cares? Right now we're at 8.5% or something like that in this country. Guess what? I don't care. What's it matter to me? Doesn't matter, because my money's working for me and making a lot more than that. And that's what I want all of you guys to be able to do as well. Taxes. That was in those top 3 wealth killers I showed you guys a second ago. What do taxes do? Do taxes go up or down, historically speaking? Way up, way up. It's interesting. If you ever have time, go back or watch a presentation on taxes and the evolution of taxes in this country, and look at when they first came out with the tax code, what people paid in percentage to their incomes and things like that. And look at it today. It's mind blowing. And guess what? The national debt in this country is over $30 trillion. What are we doing with policy every month? We're creating more and more spending. We're just spending and spending and spending and spending. And all that spending eventually is going to have to be paid for at some point. It's either going to be paid for through more inflation. It's either going to be paid for through higher taxes. But I can promise you one thing, taxes will never be lower in your life. They're just going to keep going up and up and up. So why do we keep putting our money in places that are tax deferred? A great example of that, your retirement account. How many of you guys on here right now, 401ks? Anybody have 401ks you're putting money into on a regular basis? Why? That 401k is tax deferred money. So you're putting your money in a place that you're losing control of it. Because when you put your money in a 401k, if you want to pull it out to buy a house or buy a rental property or go on a trip or do whatever, what are they going to do? They're going to charge you a 10% penalty plus taxes for pulling that money out of your 401k. So you're giving up control of your money. You're putting it into a vehicle. The 401k is going to allow you to invest in stocks, in indexes and things like that, but it doesn't let you invest in anything you want to. You can't go buy Airbnbs with your 401k money. So you're giving up control, not only for what you can spend it on, but also for investing. And then you're deferring the taxes on it until you're retired. Well, if I'm 39 years old, I retire when I'm 59 years old, or when I'm able to access a 401k at least at 59 and a half years old, that's 20 years from now. I would be willing to bet whatever amount of money any of you guys want to bet me right now on this call that in 20 years from now, taxes will be higher than what they are today. So why the hell am I deferring paying that till later? So it's things like that right there. Again, why do we invest in 401ks? Because that's the way it's always been. That's what we were told to do. That's what everybody else does. Remember those wealth killers I was telling you guys about? That's it right there. Live and in person. So we want to start putting our money in smarter places. We want to put our savings. We want to put our investments. We want money to flow into much more advantaged vehicles, like I'm going to show you tonight. Now, I'm not saying don't put money in a 401k, but if you're putting above a match, maybe you want to back that off a little bit and redirect that money somewhere else, and so on and so forth. But that's things that we can talk about on that phone call. So one more time, get the bonuses, but more importantly, schedule a call with me so we can talk about your personal situation and what that looks like. All right. So let's continue talking a little bit about money. So how does money flow? How does money flow? Check this out. And what I mean by that is you would think that if you're earning 4% on your money, and you're paying 6% on your money, that you'd be losing money, right? I mean, that's kind of like common sense. If you're earning 4 and you're paying 6, you're going to lose money, right? But let me show you a little bit more to it, because that's one of the cool things with money is we can kind of do some things with numbers to show you exactly what I'm talking about. And this is going to relate to compounding interest. I told you before, we're going to talk a lot about compounding interest tonight. So this is the start of that right there. So let me set up a situation for you. All right. So you want to buy a car. That car is $25,000. I'm using round numbers for this example here, right? So this car is $25,000. So you go down to your local bank and you got $25,000 you've been saving in your savings account. And you're like, hey, Mr. Banker, I want to pull $25,000 out of my savings account because I'm going to go buy a car. And you think you're doing something great because you're paying cash for it, right? And I'll get into that in just a second, but let me show you this. So you go down to the bank, and then the banker says to you, hey, listen, what we can do, here's what I'm going to do for you. Instead of you taking that money out of your checking account, your savings account, I'm going to allow that money to remain in your savings account. And then I'm going to give you a loan against that money. So we're going to use that $25,000 as collateral. And when that money sits in your savings account, it's going to grow at 4% annual interest. Now, I know there's no banks out there that are paying you 4% right now in a savings account, but I'm going to do this for my point right now anyways, okay? So you say to the banker, okay, we can do that. I wouldn't mind if my money stayed in there compounding at 4%. So go ahead and give me the loan. And the banker says, okay, here's the loan. I'm going to give you $25,000 in this loan, and you're going to pay me 6% on that $25,000. And then you say to the banker, you say, listen, Mr. Banker, I know you're supposed to be the money guy. You're the banker, but there's no way in hell. Why would I do that? Why would I have my money grow at 4% while I'm paying you 6%? I'm not the smartest sharpest tool in the shed, but I'm smarter than that. 6% is more than 4%. So no. Good try, banker. I know you guys are always trying to screw people. That's why you have those little lollipops in there that are called dum-dums, because you think we're all dummies for coming in bank. But so no, I'm not going to do that. You give them and the banker says, no, you're not understanding money. So you guys get into this and they say, okay, let me prove it to you. Any of you guys thinking that right now? Let me prove it to you. All right, check this out. So you say, all right, if you can prove it to me, then I'll do the loan. I'll take it as 6%. So watch this. You take the loan, and if I had a compounding calculator up right now, you guys can do this math yourselves, but here's how it works out. So I take a $25,000 loan at 6% over the next 5 years. That's a typical car note, right? 60 months or 5 years. Over that time span, that $25,000 at $483 a month at 6% over 60 years or 60 months is going to become $29,000. So essentially, we're paying the bank $4,000 in interest at 6% over those 5 years. And that $25,000 has now become $29,000 for the bank. Now, check this out over here. This $25,000 sitting at the bank over the same 60 months, $25,000, but compounding at 4%. Guess how much that's going to grow to be? $30,500. So the 25,000 at 6% became 29. The 25,000 at 4% became 30,500. So we just made $1,500 by accepting a loan at 6% while we're earning 4%. Now, why does that happen? Well, A, this money's over here compounding. Remember what Einstein said, compounding interest is the eighth wonder of the world. This $25,000 over here is a depreciating amount balance. So each month I put 483, I pay 483. It reduces the balance of this. So over the 5 years, that balance goes down and down and down, while the balance over here goes up and up and up. So even though we're earning 4 and paying 6, we're still able to make $1,500 during that 5-year time span. And as I go here tonight, we're going to start talking about this. Borrowing money. We're going to talk about compounding money. We're going to talk about investing money. And this is important to remember as we go here tonight. So just know it is possible to make money while paying 6 and earning 4%. So what is the money multiplier method? So the money multiplier method is going to consist of 3 different parts. A, the machine, the vehicle that this whole entire thing is built around. And I'll show you in 2 seconds what that is. B, the marathon. And what I mean by the marathon is you're not just going to stick your money into this machine and overnight you're going to become a multimillionaire. It's going to take some time. Compounding interest works off of time. Now, I don't care if you're in your 70s. I know a couple of you on here right now are. The machine will still work, right? You still have plenty of time, but it is a marathon. This is something that's going to take a few years to become efficient. And then we're going to start really taking off with this rocket ship that I'm going to build for you, this machine. But it does take time. I just want to make that clear right up front. And number 3, the millionaire. You use the machine. You follow the process. This is what the infinite banking concept is all about. This marathon, this process, you will become a millionaire, or your family will become millionaires. This is what it's all about. So let me show you what I'm talking about. What is that machine? What is that vehicle that we use? It's nothing more than a dividend paying whole life insurance policy from a mutually owned insurance company. That's it, guys. That's what this machine is. That's what this policy is. It's a whole life insurance policy, dividend paying with a mutual company. Now, let me make this very, very clear. This is not a whole life insurance policy that you can call your buddy from high school or your uncle or your aunt, or everybody knows somebody that sells insurance, right? This isn't something you just call State Farm, something you call New York Life. It's not something you can just call and say, hey, I want one of those whole life policies so I can do infinite banking. They're going to say, okay. And they're going to sell you a off the shelf standard whole life insurance policy. That's not what this is at all. This is a specially designed and engineered whole life insurance policy built specifically for privatized banking to be used with the infinite banking concept. This is all that we do. Okay. So I've been talking about scheduling a call with me, right? Well, that's what we're going to talk about on that call, is how to specially design and engineer your whole life policy so you can do this. That's it. Okay. And I want to make that clear. This is all we do at the Money Multiplier all day, every day, is we build these policies. We design these policies and we help people use these policies through our mapping team that I'm going to show you in just a second. So that's all we do at the Money Multiplier. You'll never pay me a dime to do this for you. I make commission directly from those mutually owned insurance companies for bringing them the business. So you don't pay us a dime for any of this work now, during, or in the future for years to come. This is all just included as being a client of ours, but I want to make clear this is what we do all day, every day. Okay. And we use several large companies. They are some of the most well-known and strongest financial companies in the country. It just depends on your situation and what's the best fit for you. So we'll talk more about that as we go. And just one more note, check out something called bank-owned life insurance. So when we get off here, Google BOLI, B-O-L-I, bank-owned life insurance, and read a little bit about it. Banks are the number one purchasers of whole life insurance in this country. Did you guys know that banks, their M1 money supply, where all of their money goes, all of their assets, are in two places? Number one are whole life insurance policies. Number two is real estate. Do you think there's a reason that we focus our financial strategies and education on whole life insurance, this concept, and real estate? Banks know what they're doing. Banks are very, very successful. I mean, just look around. There's banks everywhere. They own property everywhere. They're in some of the most beautiful skyscrapers in the largest cities around the world. These are banks. These are bank buildings. Like, they're everywhere. They know what they're doing when it comes to money. And that's what we're doing. We're mimicking a lot of that. We're mimicking what the banks do. So check out BOLI, check out bank-owned life insurance, and you guys can read more about that as we go. So who else uses this concept? Who else uses whole life insurance policies to build and grow wealth and fund their investing and fund their businesses? Well, check this out. Jim Harbaugh. Cash value life insurance makes Harbaugh college football's top paid coach. Harbaugh's been a football coach for many years. He's now with the Michigan Wolverines. And this article from November of 2016 talks all about how he uses this type of deferred compensation alternative appeals to talented leaders and executives. Joe Biden, the president of the United States. Check this out right here. Biden holds 2 checking accounts. In addition, he holds 6 life insurance policies with Mass Mutual. That's one of the mutually owned insurance companies that we write business with. The Biden's reported an adjustable gross income, blah, blah, blah. So Biden has these policies that he's building wealth in. And a lot of times for people like these guys, not only is this a great strategy for building wealth, but it's private and it's protected. Whole life inherently has a lot of asset protection built in, a lot of privacy. Like, we can't go like check that out. Like, we can look at Biden's tax returns and see what he invests in and how much money he has in his savings accounts and things like that. But how much they actually have in these insurance policies is very private information. In most states, they are protected against lawsuits and bankruptcies and things like that. So it's a lot of asset protection built into these, and why high net worth and individuals like these people use these policies for their money. How about Walt Disney back in the day? Walt Disney wanted to start Disneyland, but after failing in his pursuit of traditional financing to build what would later become Disneyland, Walt decided to build his own financing. A large part of this came to be by collaterally borrowing money from his cash value whole life insurance policies. A couple other people, the Pampered Chef, using $3,000 she borrowed from a life insurance policy. Home economist Doris Christopher started the Pampered Chef in her suburban Chicago home in 1980. By 2002, the company had grown into a $700 million operation, was acquired by Warren Buffett for $1.5 billion. Ray Kroc, partner with McDonald Brothers. In 61, he bought out the brothers. Kroc did not take a salary for the first 8 years. And to help with cash flow, he borrowed money from his 2 cash value life insurance policies to help cover salaries of key employees. He also used some of the money for an advertising campaign for a mascot called Ronald McDonald. Also, some of the wealthiest families in the country over the last 200 years, people like the JPs, Morgans, Chases, Vanderbilts, and the Rockefellers. So if they're doing it, don't you think it's maybe something that we should look at ourselves for our families? Absolutely. All right. So pivoting back to the banks for just a second, I do want to just hit on this real quick. So, understanding how money moves and money flows and keeping money moving at all times is very important. And again, if the banks do it, why don't we do it? So let me show you how banks do this. So if I was to take $100,000 right now and go down to the local bank and put it into that magic savings account that's paying me 4%, do you guys think that the bank just takes that $100,000 and puts it into like a safe deposit box or some little locker? They write my name on it and then they wait for me to come get it? No, obviously not, right? They take that money and they get that money in movement immediately. And then when I come back for it, it's not even there. When's the last time you tried to take cash out of a bank, right? But different story for a different day. All right. So what the bank does is they work off of what's called a spread. And a lot of what we do is off of a spread. So I'm earning my 4%, but then the bank takes that money and they start moving it. So what they do is they have it available. So let's say I want to buy a house. So I go to that bank and say, hey, I'd like a home loan. They say, okay, no problem. We'll give you a loan at 7%. So I take that money that they give me, I give it to the sellers of the house. Then the sellers of the house, what do with it? They take it and they put it right back in the bank. And then let's say that I want to buy a car to park in the garage of my new house, right? So I go to the bank, they give me a car note for 8%. I go down to the car dealer, I buy that car, and the car dealer takes it. What do they do with it? They stick it right back in the bank. Same thing, a home remodel loan, give it to the contractor. And then let's say you have some debt. You want to do a debt consolidation loan, give it to the credit cards, put it right back in the bank. So the bottom line is the bank takes that money that you're putting in there and they start moving it and they start working off the spread. So check this out. What did the bank just do? We made 4%. The bank just made 3% on that home loan. The bank made 4% on that car note. The bank made 5% on that home remodel loan. The bank made 8% on that debt consolidation loan. So the bank just made 20%. If I add all that up, the bank just made 20% off of me. Is that right? Wrong. Check this out. The bank just made 500% off of that $100,000 that I stuck in there in my savings account. How do I come up with 500%? Well, they're paying me 4%. They made 20%. That's 5 times the money, 500%. They just made off the money that I'm leaving at their bank. So let me ask you guys this question. Why do you keep putting money in the banks? Why are you letting banks make all of this money off of your hard-earned money? Why aren't you making it yourself? And this is another thing I want you guys to look at. Go to BauerFinancial.com, BauerFinancial.com. This is a research group that just researches banks and puts out data about banks. And everything you want to know about banks, BauerFinancial.com. And they say right there, you guys can check this out. Banks make between 400 and 1,300% on money that you leave there. So let me ask it this way. If you owned a hair salon, where would you get your hair cut? Or if you owned a restaurant and you had friends in town, where would you take your friends and family to eat? At your own restaurant? Or if you own a gym, you guys ever go to a gym and you see the owner of the gym? They're always there, right? They're always there working out, because why would you go somewhere else? Well, let me ask you this. If you owned a bank, where would you do your banking? At your own bank, right? Obviously. So why are you making other banks 400 to 1300% off of your hard-earned money? How many of you would like to start earning that yourselves? How many of you would like to keep all of that money you're giving away to other people right now within your and your family's financial lives forever? And that's what be your own banker means. That's what BYOB is all about. Let's stop making everybody else rich, and let's keep that money within our financial lives and our families' lives. And that's what this is all about. So let me show you how we start to do that. This is what we call an annual pattern of spending. So if we take a dollar bill and we look at the average American and how they spend money, okay? The average American, if we take a dollar bill, 20 cents of every dollar that they earn goes to a car, whether it's payments or gas or upkeep or whatever the case is. 20 cents of every dollar goes towards a car. 30 cents of every dollar that we earn goes towards housing. 40 cents of every dollar we earn goes to everything else. So that can be travel, kids, entertainment, food, whatever the case is. So what does that leave us with? 90 cents of every dollar we earn is going to other people. That leaves us with 10 cents that stays within our financial lives in the form of savings, right? And on average, that's what the average savings rate is in this country, 10%. Now, right now, during COVID, I saw it spiked a little bit. And then now since COVID, it's dropped and it's actually below pre-COVID levels right now. So savings rates are dropping right now, but let's just use 10% as an average. Okay. All right. Now, how do we start keeping all that money we're giving to everybody else within our financial lives? So let's build this backwards. Let's start with the 10 cents in savings. All right. So like I said before, if 20 cents of every dollar is going to your automobile, on average, 5 cents of that 20 cents goes towards interest payments. Okay. And if you're like, oh, I'm going to buy cash, so I don't have any interest going to anybody else. No, first off, you're giving up opportunity cost. And second off, I already showed you how that worked earlier with the borrowing at 6% and earning 4%. So stop right now. But on average, 5 cents of every 20 cents goes to interest on an automobile. So what if we could just take that 5 cents that we're giving away to the finance company? What if we could just keep that into our own savings? Let's do that. What we were able to accomplish right there is we just increased our savings by 50%. We didn't work any harder. We didn't work any longer. We didn't take on any more risk. We just changed where the money flows. So instead of the money flowing into somebody else's bank and then going to buy that car, the money's flowing into our bank and then going to buy that car. And by doing that, we're able to recapture that money and that interest into our financial lives and increase our savings by doing that one thing by 50%. And I'll show you exactly how to do that buying a car in just a second. It's my next example. How about housing? Did you guys know that 25 cents of every 30 cents that's spent on housing goes to interest? And if you're renting, again, then 100%, because that's all out the door, right? But 25 cents of every 30 cents goes to interest. Why is that? Because banks are very, very smart. Did you know that on average, a 30-year fixed mortgage, over 90% of the interest paid to a bank on a 30-year fixed mortgage is paid in the first 7 years? Over 90% of that interest is paid in the first 7 years. Did you know the average American either refinances their house or moves and gets a new mortgage on average every 7 years? Banks are very smart. They know what they're doing. So let's recapture that money that we're giving away to everybody else right now. I'm working with somebody right now that they bought a condo, and we're building a policy specifically just for this process right here to recapture and get that condo paid off not only quicker, but also keep that interest within their family. So let's take that 35 cents or 25 cents and put that into our savings. And then if we look at the 40 cents that goes to everything else, about 5 cents of that goes to interest. So we're going to recapture that 5 cents as well. So by just recapturing the money and interest that we were giving away to everybody else, we just increased our savings by, I don't even know what that percentage is, but instead of 10%, it's up to about 50%. You guys like that? All right. So I told you the next example is how to get back all the money for every car you'll ever buy, drive, and owe. Let me show you exactly how this works. But before that, let me show you the machine. So let's take let's take a look under the hood, right, of that car. Or in this case, let's take a look under the hood of this whole life insurance policy. So this is what we call a money multiplier whole life insurance policy. So this is what we call an illustration. And all of you guys will see your illustration before you ever start or anything like that. But this is a policy year. This is the age of the individual. In this case, this was a 26-year-old person. They're putting $10,000 a year into this policy. I don't care how much you put into it. You could put a couple $100 a month. You can put a couple $1,000 a month. You could put a couple $100,000 a year. You could put a couple $1 million a year into this thing. Doesn't matter to me. You tell me how much you want to put into it. I'll strategize with you, but you're going to ultimately tell me. For this example, this person is putting $10,000 a year into their policy. These are going to be the recapture of the payments. This is the purchase. This is the cash value that's available for loans from the policy to use for these things. And this is the death benefit. Okay. So that's a typical, what we call an illustration. So a couple things to note here. These, you'll see the word deposits. These are premiums that are going into that whole life policy. Again, we're building this backwards. I'm not saying, hey, I'm going to give you $1 million death benefit. This is how much it costs you. You tell me, I want to put $10,000 a year into the policy, and the death benefit is what it is. In this case, it was $680,000. So we're going to build this backwards, but I also want you to think of it a little bit backwards. So instead of these being premiums going into this policy, these are now deposits going into your banking system. Okay. Because nobody wants to pay a premium, but everybody wants to go down to the bank and deposit money into their bank account. So you do the same thing with this. They're no longer premiums. They're now deposits. Age doesn't matter. You can be 6 months old. You can be in your 70s. And if your health is not good, if you're 80 years old, whatever it is, we have solutions for that. You can own the policy. You can control the policy. You can do banking with that policy. Everything I'm teaching you here right now, we're just going to have to insure somebody else's life. So the death benefit will be on them instead of you, but who cares? You're still banking. You're still taking advantage of all of this. And that's what matters. So the age, health, it doesn't matter. And the death benefit, again, we build these things backwards. So again, that doesn't really matter. All right. All right. So again, the deposits going into this thing, the cash value that's available. So they put $10,000 a year into this thing. In the third year of this policy, they decided they wanted to buy a car. Now, what they did the first 2 years of this thing, I don't know. They probably paid off some debt, recaptured the money. But in the third year, they wanted to buy a car. So they take a loan for $25,000. Now, if you go to the bank and you buy a car, you're going to pay the bank back, right? So if you go to your policy, your own bank, and you buy a car, then you're going to pay yourself back, right? So in this case, we're paying back $6,000 a year. So $70,000 went into this thing. $30,000 was recaptured back into it. We took $25,000 out of it. So we put a total of $75,000 into this banking system. Look at this right here. Cash value. This is the amount available for loans. So we put in $75,000. We bought a car for $25,000 that's sitting in our driveway, paid for cash that we can do whatever we want with it. And we still have $67,000 in our account. So what does that tell me? We were able to recapture 91% of all the money that we paid for that car. We were able to recapture. Not bad. Because typically speaking, you're going to buy the car for $25,000. You're going to pay the bank back. Now you have a car, but you don't have any money left in your account. Here we got $67,000 available for what? Whatever you want. In this case, we're going to buy another car because I told you we're going to recapture all the money, not some of it. So this thing's going to keep going. Now, for this example, you're going to stop putting deposits into this policy. In the real world, you're going to want to put more money into this thing because every year the compounding is going to get stronger and stronger and stronger. Look at this. I mean, year one, they had 5,800 available. In year 7, they now got 67,000. So this thing's going to compound stronger, stronger, and it's never going to stop. It's just going to keep compounding. Boom, 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 boom. But in this case right here for the example, in year 8, we pulled out $25,000 to buy another car. So we did the same thing. We recaptured the money, we brought it back in. So in this case, we put no new deposits in, but we did recapture $30,000 and we spent $25,000. So a total of $5,000 that we net injected into this policy. Now, even though we only put $5,000 into it, look what happens. This policy grows by 9,000, grows by 10,000, 10,000, 11,000. This thing just keeps growing more and more and more, even though we're not putting any new deposits into it. We're only recapturing that money. So what do we have now? We have our money grew from 67,000 to 91,000, and we put no new deposits into it. So what do we do right here? We bought 2 vehicles that are sitting in our driveway, paid for cash, that we paid 50 grand for. We put money into this policy, and now we have $91,000 available to us for the next use. So I spent $50,000 on cars, and I now have 91,000 sitting there in my account ready to go. Seems like I just recaptured all the money for all those cars, doesn't it? And if this works for cars, what else does it work for? What other kind of purchases? So these are the 3 rules that you need to follow for this concept. Now, these are rules. You can break the rules, but these are rules that we're going to teach you that you should follow when you do the infinite banking concept. So rule number 1 is pay yourself first. So always deposit money into your banking system. Again, if you go down to the bank to put money in your savings account, you're excited for it, right? So be excited to put these deposits into your banking system. Number 2, pay yourself with interest. So if I'm going to borrow money from my banking system to go buy a car, why not charge myself interest just like the bank would charge me? If I'm going to pay the bank interest, why wouldn't I pay myself interest? So always pay yourself with interest. And number 3, always recycle and recapture the money. Okay. But here's the difference. If I go down and I take a loan from the local bank and I stop paying my car note for a few months, what's going to happen? Well, the tow truck company is going to come on down, and all of a sudden I'll look outside one day and they're going to be hooking up to my car and they're going to be towing that thing away. They're not stealing it, they're repossessing it. And if you've ever been through that before, it's not a fun feeling. Because why are they repossessing it? Because I didn't pay the bank back the money. But here's the difference. If I borrow money from my own bank and I get into a weird financial situation where I can't make those payments back to myself, well, what's going to happen? Nothing. It doesn't matter. You're in charge. You're in control. You set the terms on how this works. So if I don't pay myself back for that loan that I took to buy that car, it doesn't matter. I'm going to cut myself a break. I'm going to say, hey, Steven, just start making payments again whenever you can. It's no big deal. And that's the beautiful thing about this is you are in complete control at all times. And again, if this works for a car, what else? Airplanes, boats, trips. All right. So let me ask this question. How many of you have some debts? Anybody have debts on here? Let me show you how you can pay off your debts faster than without this, while continuing to build wealth for you and your family. Watch this. This is really, really cool here. All right. All right. So this is a real case study that we did with our mapping for one of Brent Kessler's clients several years ago, who was a chiropractor. So this is a 45-year-old chiropractor, a male. He had 9 third-party debts totaling $478,000. He was paying out $70,000 a year or $50 a month to these debts, to third-party debtors. So we did the math on this. If he would have just followed this payment schedule to pay all this off, it would have taken him 19 years. Who wants to wait 19 years to be debt-free? Not me, right? So here's what we did for this guy. Check this out. So what we did is we started a policy for him at $25,000 a year. Again, you tell me how much you want to put into it, but this chiropractor made good money. He just happened to run up his debt tab. He happened to buy a lot of stuff and spend a lot of money and got into some debt. It happens. It happens to the best of us, but he made good money. So he said, I'm going to start a policy for $25,000 a year. So the first year of this policy, he put $25,000 in. He had $15,000 available for a loan. That's what the cash value is. Now, the policies that we build nowadays are a little bit stronger. So you're going to have higher cash value available quicker. I mean, I can get you up over like 20, 22,000 in cash value the first year. But in this example right here, he had 15,000 available. So what we did is we took that $15,000 and we immediately paid off. And again, he took this loan within the first 30 days. You put the money in there, 25,000 in, you immediately pull it right back out to do this. Okay. So I make that clear. So it immediately pulled that loan, paid off the Discover card, paid off the Lowe's card, and paid down the Nordstrom card. So what we did right there is we eliminated $448 that he was given to other people. But we want to recapture that money back to ourselves, right? Remember, rule number 3. So that $448 a month that he was given to Discover and Lowe's, he's no longer sending it to Discover and Lowe's. Where is he sending it now? He's sending it to the Bank of Snaggy. He's sending it to his own bank, right? So now that $448 a month is going to his own bank, and $5,329 is going to third-party debtors. Second year, $25,000 goes in the policy, $16,000 is available in cash value. And then we also have $5,300 in payments that we can use. Where did those $5,300 in payments come from? Down here. The $448 that we were given to Discover and Lowe's that we're now paying to ourselves, that adds up in what's called a segregated bank account. We'll teach you this stuff. But he now had 5,300. So we had a total of 22,000 available to tackle the second year's debts. So we took that 22,000, paid off the Nordstrom, paid off the Wells Fargo, and paid off the private loan, paid down the BMW. So we now increased the amount we're paying to ourselves to $1,900 a month, and dropped the amount we're giving to third-party debtors down to $3,800 a month. Year 3, 25 goes in. Now I got 25,000 available and 23,000 in recaptured payments for a total of 48,000. Pay off the BMW, pay off the West Marine credit card, and pay down the condo. Now we have $3,600 back to ourselves, $2,100 going to third-party debtors. Now, let me make sure you guys are following me here. Here's a little quiz. What have we done so far? We put $25,000 into the policy each of the first 3 years. We took $55,000 out of the policy to use to pay off debt. So if I put $75,000 in and I took $55,000 out, how much do I have remaining in the policy? How much? All right, Todd and Madeline are saying 25,000 or 75,000. I love it. You guys are learning very, very well. All right, you're absolutely right. 75,000. It's not 20,000. That's the old way of thinking, but the answer is actually 75,000. And why is that? That is because this money that we put into this policy, it's going to compound and grow uninterrupted for the rest of your life. Because when we take these loans, these $55,000 in loans from the policy, we're not actually taking our money out. We're borrowing money from the insurance company's general account, and we're using our policy as collateral for those loans. So that's what allows our entire money, all of the money we put in that thing, to always compound and grow for the rest of your life. So those of you that said 75,000, thank you. You guys are paying attention, and you're absolutely right. All right, 4th year of this policy, 25,000 goes in, 26,000 available, 44,000 for a total of 70. We're going to pay down the condo. Year 5. Now we're able to pay off the condo and lower the house payment or the house balance. 4,500 going back to ourselves, and now only 1,200 going to third-party debtors. Year 6 of this policy. Check out what happens in year 6. So each policy at some point, the amount that you're depositing into it is going to lower. And the reason for that is IRS. The IRS has rules and regulations on how these policies function. It's something called the MEC rule. It stands for Modified Endowment Contract, the MEC rule. The MEC rule is something that when we design an insurance policy, one of these policies, we have to work within the MEC rule. And if you mech the policy, it turns it taxable and all this stuff that we don't want to happen. So we have to work within it. So what happens is that at some point, the amount that you're depositing into the policy is going to be lowered because of that mech rule. Now, usually it happens after year 10, but in this case, it happened in the 6th year in this policy. So in the 6th year, he was only able to put $10,000 into his first policy, but he loved the way that this was working and he wanted to put more money into his banking system now that he was starting to eliminate some third-party debt. So how do we do that? If you can only put $10,000 in, but you want to put $35,000 a year in, what do? Well, you open additional policies. So you can open essentially as many policies on yourself as you want, or you open them on your spouse, or you open them on your kids, or you open them on business partners. But this is how you start opening, or this is how you start building and growing your banking system. You start opening additional policies and stacking policies to grow your banking system. So in this case right here, he opened a second policy, putting another $25,000 a year into that one. So his first policy puts 10,000 in, now it's 13,000 available for a loan. Second one puts 25,000 in the first year of it, back down to the cash value of only 15,000. Payments of recapture payments of 55,000, total cash of 82,000. So we have 82,000 available now to tackle the debt. We only have $76,000 left. So in the 6th year of doing this, of this debt pay down, not 19 years, in 6 years, he was able to eliminate all third-party debt and all interest that he was giving away to other people instead of his own financial family's lives in 6 years. Now we have $5,700 a month, not going to any third-party debtors, but going back to our financial lives. And we're going to continue to pay that back to ourselves. We're going to continue to pay that back until the loans are replenished, and then we're ready to do this over and over and over again. And this is stuff that we do for you. So like I mentioned before, we don't charge for any of this stuff, but we're going to create a debt map. So those of you that are scheduling calls with me, which I'll put it in one more time, those of you that are scheduling calls with me, we're going to talk about and get your policy going. And then once your policy is in force, immediately you go to the mapping team, you pull your first loan immediately, and then they're going to create this plan for you. It's called a debt map. They're going to do a debt flow analysis with you. They're going to look at, your cash flow. They're going to look at your debts, interest, balances, all that good stuff. And we're going to create this plan for you. And then we're going to meet with you every 3 to 4 months to update it, see how you're doing, see if anything's changed. And we're going to help you do this. So don't worry, we don't leave you on your own. We're with you every single step of the way. I like to kind of refer to it as a financial GPS, because if we know where we are now and we know where we need to go, we're going to create a plan that gets us there that much quicker. So this financial GPS becomes very, very important. All right. So here's the question. What if you don't have any debt? What if you don't need to buy a new car? Can you still benefit from privatized banking? Should you still become your own banker? And it's a resounding hell yeah, because that's where the fun begins. That's where you can really start moving money. That's where you can really start doing some cool things with business. That's where you can really do some cool things with investing. And guess what? You're going to need a car in the future. You're going to need to make purchases in the future. So you'll be able to use these policies down the road, but don't worry. Let me show you if you're in like the growth mindset right now or the investing mindset. This is where this becomes a lot of fun. This is where we call the millionaire. So this is how we're going to start creating wealth. And again, it doesn't matter how you create wealth, just that you are creating wealth. So it can be a business. I can show you how to use this policy to lend your business money to get all kinds of tax deductions while continuing to build wealth over here. And your business gets what it needs. Cash flow. Is cash flow important in business? Absolutely. Or if you're a real estate investor, you're getting these chunks of money or in between deals, the money's just sitting around. Well, let it warehouse in your own private banking system. So you have compounding growth while you're doing your real estate deals, or do private money lending. If you're passive, private money lending or notes, where you're putting your money somewhere and you're making that spread while the money's compounding and growing. So it doesn't matter how you're investing. And we can teach you this stuff too, guys. This is what we teach with Money School. So that event that I mentioned earlier in July, we're going to teach you all of these strategies and techniques. But all of this stuff should be and can be used in conjunction with your privatized banking policy. And really, over the years, I found there's 2 ways to truly create wealth. Number one, compounding interest. And number two, money movement and flow. Money sitting still is losing money. Money in motion is always making more money. So I'll show you how we do that in just a second. So here's one more. This is what we call an illustration. This is a real illustration I did for her. This was a female, 41 years old. She was in good health, and she wanted to put $150,000 in up front, but she only wanted to do $50,000 a year moving forward. So that's one of the other things that we can do is we can front load these policies the first year or two and really load them up, get the money in there, start that uninterrupted compounding interest, pull almost all the money right back out to get that money to work. In this case, they're real estate investors. So they had $150,000 sitting there and they're like, why are we letting the banks get rich? I'd rather put that in my own bank. But they had another deal coming up. So we dumped that 150,000 in, but look at the cash value on this thing. When they dumped that money in there, they had $130,000 in cash value to immediately pull right back out. But again, it gets it in there. Look at the fifth year of this policy. Put 50,000 in, they now have 57,000 growth. I mean, this thing, look in the 11th year, put 17,500 in. The policy grows by $45,000 that year. I mean, it's just amazing the power of uninterrupted compounding interest. So we can load these things up and design them however you want. Here's another example: 50,000 going in the first year and then $500 a month. So they dumped in 50,000. I think this is when they had cashed out some stocks or something like that, or maybe they had a HELOC or they were using some equity from a home or something like that. But they dumped 50,000 in, but their cash flow only allowed for $500 a month or 6,000 a year. So we designed this one, 50,000 going in up front and then $500 a month for them. And this thing just kills it as far as returns and what's available over time. So this is a quick example of how money flows using a policy. So this is a money multiplier policy, insurance policy is where that the money is housed. Then you take a loan from the policy. The insurance companies charge, depending on the company, anywhere from typically 4 to 5%. We can do like a line of credit and get you down in the threes right now, but typically 4 to 5% is what the insurance company is going to charge when you use the money. So that money goes into that segregated bank account. The segregated bank account is just used for accounting purposes and tracking purposes. And the segregated bank account is just a checking account. So just a plain old simple checking account used specifically for the policies in your banking system. So the money goes from the policy into the checking account, from there into whatever investment you're using. In this example, it's a private money loan at 12%. So those monthly interest only payments are coming from that private money loan back to your segregated account. You're earning the spread. So the spread between that 4% and that 12% you're making in profits. And then the rest of that money is just going to capture right back into the policy. And really, if you're recapturing the money monthly, you're not going to pay 4%. That's 4% annual return. So you're going to pay a lot less if you're funneling the money back in. Remember, depreciating balance. Remember what I said earlier. When you have a depreciating balance and a compounding increasing balance, the spread's a lot different. But that's what's happening right here. So this is how the money flows, just to give you a basic example. So flows back into the policy to be used over and over again. This is the circle. This is what it's all about. Keep that money moving and keep that money making more money at all times. So here's an example of using one of these policies in a private money loan. So we're going to use this policy, let's just say in the 8th year of it. So in the 8th year of that policy, their bank grew by, their savings account, let's say, grew by $66,000. To earn that $66,000, they had to inject $48,000 into that policy. You see that? So their annual premium that year deposit was $48,000, and the policy grew by $21,000 for a total of $66,000. So that's a $18,000 in growth. That's a 37% cash on cash return. And then what we did is we took that money, we lent it out at 12% on a private money deal. So right there, we earned 12% on the private money deal. Our bank grew by 37%. We paid Lafayette Insurance Company 5% to use the money for the year. Again, it's probably gonna be a little bit less, but for this example right there, 5%. So we made a total of 44% return on our money. So let me ask you guys this question. Would you rather make 12% on a private money deal or 44%? You tell me which one. We didn't do anything different. We didn't work any harder. We didn't take on any more risk. It's just where the money came from. Instead of lending that money from a traditional bank and earning 12% on the private money deal, we lent the money from our private bank, my bank. And not only did I get the compounding returns, but I also got the 12%. So I made 44%. This is what becoming your own banker is all about. You guys like this? The death benefit's tax-free, creates a legacy for you and your loved ones. So when the money goes in, it's going to go in after tax dollars. Once it's in there, it grows tax-free. The loans come out tax-free, and the death benefits paid out tax-free. Again, what are taxes doing all the time? They're going up. So let's put our money and our wealth into places where we're taking advantage of these laws. It's why we use life insurance policies. It's the only vehicle that allows us to do this with it. There's no other product. There's no other vehicle. There's no other machine in the United States of America that does this for you. If you guys have one, please tell me. I'll happily use it. The only reason we use life insurance is because it's the only thing that allows us to do this. Loans never have to be repaid. Remember before I told you that you're in charge of those loans and the terms. Well, if you decide to never pay them back, nobody cares. Doesn't matter. The insurance company doesn't care. It's completely up to you. I mentioned this earlier. Policies are exempt in most states. Business uses are really, really cool loans versus using a COLI strategy. So on our strategy call, if you want to use it for business, ask me about that. And I'll get into more detail. I'm running out of time right now, so I'm not going to get into it, but ask me about that right there. Oh, and kids policies. Those are one of my favorites. Those of you that are saving for college or want to teach your kids financial education, the kids policies that we do with these things are unbelievable. I started one for my 5, he's 6 now, but for my son last year when he was 5. And that thing's really, really, really amazing what it does when he turns 16 and he needs to buy a car and when he gets to college and expenses and things like that. So the kids policies are amazing as well. But this is how you start building a banking system and creating a legacy for you and your family. So why aren't more people successful? I don't know. These, in my opinion, once you learn how to eliminate that, I mean, I literally just showed you these policies are guaranteed growth. It eliminates volatility. Inflation, we're moving our money and we're beating inflation every single day. Taxes, we're putting our wealth into a place with tax-free growth, with tax-free usage, with tax-free death benefit paid out to our family down the road. So we're eliminating taxes. And then with Money School, we can teach you other strategies to reduce taxes on a daily basis. But this policy is eliminating all of this stuff for you. And it's getting rid of all the other things in life, following the status quo, life, fear, all that other stuff. We're doing what the wealthy do. We're doing what the successful do. And that's what it's all about. Warren Buffett said it best. If poor people would just do what rich people do, they wouldn't be poor anymore. I mean, Warren Buffett has such a way of saying things. I mean, he's the one who said, buy low, sell high, and don't lose money. That's the key to investing. Well, no shit, Warren, if we all did that. But so he makes things sound so easy, right? But at the end of the day, it really is. So ask yourselves these 2 questions. While I'm alive, am I better off with or without this? And once I pass away, am I better off with or without this? Is my family better off with or without this? And if you guys can answer the question that, then I'd love to talk with you. I'd love to know more about you. So please follow this link to not only get the bonuses and the books, but schedule a call with me. Or if you don't have access to a computer right now, just text me 561-313-6213. Just say, hey, Stephen, I was on your webinar. I would love to get a copy of the books and schedule a call with you. And I will send you over the link to be able to do that. That is my cell phone, my personal cell phone as well, and my email. If you guys need that stuff, it's right there on the screen with you. So with that being said, that's all I have for you here this evening on the infinite banking concept. I hope you guys got some value out of that. I will answer all of your questions right now. So put those in the Q&A box or put those in the comment box and I'll answer those for you right now. All right. Tracy is saying, if I own a business and buy a car with insurance loan, can I still write off the car as a business expense? Yes, Tracy. We've actually done videos on that exact strategy right there on how to run the money through money from the policy into your business and how to deduct all of that. We've done a couple of videos on it actually, and it's really, really, really cool strategy. That's how Chris bought his last couple of cars, his G-Wagon and his latest Maserati, using that strategy right there. and we've done videos on it. So I'll send those to you. Just email me, Tracy, and I'll email you those videos. They're on the YouTube channel though, at the Chris Nuggle. James said, yes, you can talk with a CPA for specifics about all of that. Yeah, you're absolutely right. Steve is saying, how can I get a recording of this? Do you automatically send this out to everyone? We have Steve, I have other ones. We will put this on YouTube. If you email me, Steve, I will send you a recording of this specific one. And I will ask my team to send the recording to everybody that was on here tonight as well. So you should get it automatically in the next day or two, but just in case, send me an email and I will make sure that you do get a copy of it when it's ready. What happens with the recordings for these is we have an editor that like edits out the beginning and the end, and then we upload it to YouTube. So it just takes like a day or two to do that. But once it's available, I will 100% send you a recording of it. And we do these every Tuesday. So I will be doing it next Tuesday at the same time. The following Tuesday, I will not be doing it because I'll be on vacation with my family. It's the 4th of July week, but Chris will actually be on doing the same presentation in 2 weeks. And then I'll be back the following week. All right. Gia saying, hi, if I have only 3,000 coming back in tax returns because I'm a dependent, but my co-pays and car repairs exceed it. Plus I then want to spend to start a business. Is there a way? Yeah, listen, G, you got Elizabeth, you got to start somewhere. So, you know, whatever you're working with now, whatever you're saving now, let's talk about that. Let's see if we can flow it into this policy and let's start building from there. You know, like I said, this isn't a get rich quick scheme by any means. It's not, you know, but it is get rich. It just takes a little time. So you got to start somewhere. So let's have that conversation and see what that looks like for you. How do I calculate how much to pay monthly on a loan to my bank? So Christine, that's a great question. How much do you repay yourself? First off, the mapping team can help you with that. But if you're just looking at doing it yourself, just go on like bankrate.com. That's what I usually use is bankrate.com, but just open up a financial calculator and you can put in there like, hey, I want to buy a car, for instance. And you could put in how much the car costs, how much down payment, what the interest rate is, and it'll spit out the monthly payment. And then whatever you would pay a bank, just pay yourself instead. So if it's $480 a month, just pay yourself that much. So do it whatever the bank would do. What I do when I want to, when I do a business loan. So if I'm borrowing money from one of my policies for business purposes, which actually my wife and I are actually doing this right now. We actually just bought another business. This one's a franchise, but so what we're doing is what I'll do is I will pull money from a policy and I'll lend it to my business, but I want to know how much to charge my business. So how I determine that is I'll call the bank and I'll say, hey, how much is an unsecured business loan right now from you guys? And they'll say, okay, we have unsecured business loans at 7% or 8%. And sometimes I'll ask them to send me like a quote. So that way I have a hard copy of it and I'll keep that. And then whatever the bank was going to charge me, I'll just charge my business the same amount. And I'll keep that quote just in case I ever get audited or something like that. I'll give it to my accountant. And then just in case I ever get audited, they'll be like, well, why did you charge yourself 8% for the money? It's because, well, that's what the bank was going to charge me. And I have it right here. So that's one way to do it. So James is saying, rather than open up a new policy once you're too big for your starter policy, is there a way to roll your policy? James, so that's a common question and a great question. You never want to do that. Okay. So every year you have this policy, it's going to be more and more and more efficient. So your compounding is going to be stronger and stronger every single year. And since you can have as many policies as you want, there's no reason you would ever roll an efficient policy into a new policy. Why would you do that, right? And start all over again with the efficiency. So you're going to continue the existing starter policy. You're just going to start stacking more policies on top of it. Term to whole life. Yeah. If you have like convertible terms, sometimes we can convert it, but sometimes you just don't have enough death benefit to make it worth it. So let's see. Alvin's asking, can I change my term to whole? Oh, yeah. So it just depends how long you've had it or what that looks like. Alvin, schedule a call with me and we can talk about the specifics of that with you. And Cheryl, thank you, Cheryl. I appreciate it. Chris, thank you. Thank you. All right. Oh, I got one in the Q&A too. Let's see. So on the example for paying off debt, can he keep putting the 5777 into the policy? So when you're recapturing money, it's going to go into the segregated account. And then from the segregated account, we're going to put as much as we can back into the policy. But at some point, you won't be able to put all of it into the policy because of those MEC rules. And as that money builds in the segregated account and you can no longer put it into the policy, well, that's when you say, okay, well, I got 10,000 built up in my segregated account. It's time to open another policy. So that's the other reason we use a segregated account, to see that growth and that wealth building. And then we can use that money for additional policies down the road. Michael saying, yeah, so your family is going to get all of that death benefit that I was showing you. They get all that death benefit. Whoever your beneficiaries are, you decide who the beneficiaries are. If it's your family, great. They get all that death benefit tax-free. Leah's saying, what do you mean by not having to pay back the loan? What's the minimum you need to pay towards the premium? So Leah, look at it this way. Whatever your premium deposits are, and whatever your loan is, keep those separate. So the premium deposits will continue to go in. The loan, that's up to you. If you put the money back in, if you don't, the terms are up to you. So we can talk more about that as well. All right, cool, guys. Well, I appreciate everybody being here on here with me. If you guys do have any more questions or anything specific, I'll put the link one more time. Just go on there, schedule a call. Let's talk. If you need a call scheduled outside of my call calendar, just text me. Just text me, 6213. And we'll schedule a call like in the evening or early morning or at lunchtime or whatever you need. So I hope you guys have a great rest of your Tuesdays. Make sure you join us tomorrow. What the F Happened podcast live stream can be found on Chris's at the Chris Noggle YouTube channel, as well as on Facebook. And that's at 9:30 Eastern. We have Wealth Webinar Wednesday tomorrow at 1 p.m. Eastern. That's a Zoom that you need to be registered for. I think tomorrow we're talking retirement money. So check that out and ask me anything. And then tomorrow at 4:30. And then Business Building and Precious Metals is at 3 o'clock Eastern on Thursday. So make sure you join us for that one. And I will show you, check this out real fast. On Thursday, I'm going to show you guys how I got this. Can you see it? This is a 5-ounce pure silver collectible graded coin. This thing actually has a piece of the ship from Pearl Harbor that was sunk, the Arizona, USS Arizona. That's a piece of the ship, of the deck of the ship that's in this right here, in this silver coin. So I'll teach you how I got this coin for free and how if I wanted to sell it right now, I can make $1,600 or more. So we'll show you guys that strategy right there, how to start flipping precious metals. So, all right, I'm out of here. Hope you guys have a great day. Thank you for being here. See you soon. Bye.